Welcome back to Ticker Signal, where we dig deep, unpack the research on specific stocks, and really talk about the risks. Today, we're tackling SoFi Technologies. Now, I know what you're thinking. Student loans, right? But believe me, there is a hidden engine inside this company that a lot of investors just completely miss. We're going to break down their business, look at the risks, and really get to the bottom of what makes SoFi tick.
So when most people hear SoFi, their mind immediately goes to student loan refinancing. And look, that's fair. It's how they got their start. It's what put them on the map. But if you stop there, if you value the company just on that one piece, you are missing the entire story. So let's get into it, because there is this seriously powerful engine running under the hood that most people just don't see.
Okay, before we jump into the nuts and bolts of the business model, I think it's really important to look at their mission. See, for SoFi, it's not just about slinging loans. It's about building a real long-term relationship with their customers, who they actually call members. And this mission, this idea, it's not just corporate fluff. It's the playbook for their entire strategy. It explains why they're building this huge, interconnected ecosystem instead of just being another online lender.
All right, so here's our game plan for today. We're going to start by looking beyond lending. Then we'll break down the three pillars of SoFi. We'll dig into that hidden engine I mentioned, the tech platform, and see how it powers this incredible flywheel effect. Then we'll talk about how they're fueling growth, and we'll wrap it all up with the investor's takeaway and, of course, the risks.
Okay, let's dive right in. To really get SoFi, you have to understand that it's not just one business. It's actually a trio of segments that are designed to work together in synergy. And this chart, which is right out of their annual report, it lays it out perfectly. You've got three distinct parts: lending, the technology platform, and financial services. Now, each one has its own job, but the real magic, the real power, comes from how they all connect and work together. So let's quickly touch on each one.
First up, you've got lending. This is the SoFi that pretty much everyone knows, right? Personal loans, student loans, home loans. This is the foundation of the business. It's their bread and butter, the main hook that brings new people into the SoFi world. All right, pillar number 2, the technology platform. Now, this is the part that usually flies under the radar, but honestly, it's absolutely critical to understanding the company. Through their acquisitions of Galileo and Technesis, SoFi provides the back-end infrastructure. You can think of it like the digital plumbing for other fintech companies and even some traditional banks. It's basically a B2B tech company hiding in plain sight inside a consumer bank.
And the third pillar is financial services. This is really the glue that holds the whole ecosystem together. We're talking SoFi Money, SoFi Invest, credit cards, the whole shebang. The goal here is simple: become the one-stop shop for all of their members' financial needs. Keep them engaged and make that relationship stickier and more valuable over time.
Okay, so let's zoom in on that second pillar we talked about, the technology platform. Because honestly, if you want to understand the real long-term bull case for SoFi, this is where you need to be looking.
So it's great that they have these three different segments, right? They all generate revenue, but here's the real question. Where is the profit actually coming from? Are all three of these pillars pulling their weight? Let's take a look at the numbers. Wow. Okay, so this table tells a fascinating story. Just as you'd expect, the lending business is an absolute cash cow, raking in over $660 million in contribution profit in 2022. No surprise there, but check out the other two. Financial services is actually in the red. They're spending money here, investing to grow that member base. But the technology platform, it's already solidly in the black, kicking in over $76 million to the bottom line.
And this is the key takeaway right here. That technology platform gives them a totally different kind of income. See, lending profits can go up and down like a yo-yo depending on interest rates. But this tech revenue, it's fee-based, it's stable, it has much higher margins. It's essentially a B2B software-as-a-service business that insulates SoFi from the crazy swings of the lending market. This is the kind of steady, recurring revenue that traditional banks can only dream of.
So we have these three distinct pillars, but how do they actually fit together? This is where SoFi's strategy gets really, really smart. They've engineered the business to create this self-reinforcing cycle of growth.
Now, SoFi has a name for this. They call it the Financial Services Productivity Loop. I know it's a bit of a mouthful, sounds like something from a business textbook, but the idea behind it is actually incredibly simple and really powerful. It's all about creating a virtuous cycle where every part of the business makes the other parts even stronger. And here's exactly how that loop works in practice. It's brilliant. Step 1, you attract a member with a great rate on a personal loan. Simple enough. Step 2, once they're in the door, you cross-sell them on other services, like a high-yield checking account or an investing product.
Step 3. The more they use your platform, the more valuable data you get on their financial life. And here's the kicker. Step 4. You use that data to create better, more personalized, and, frankly, lower-risk products for them down the line. All of a sudden, the cost to get that one customer is spread across multiple products, and their lifetime value just skyrockets.
Now, to get a big flywheel like this spinning, you need some serious fuel. And for a company in growth mode, that fuel is often capital. This, of course, brings up the classic investor concern, shareholder dilution. But it's so important to look at how they're actually using that cash.
Look, on one side of the coin, you have the concern about dilution, and it's a totally valid one. When a company issues new stock, your piece of the pie gets smaller. Nobody likes that. But on the other side, you have to ask the why. And with SoFi, they're not just burning cash, they're making very specific strategic acquisitions to build up that incredibly valuable technology platform.
And here's a perfect case in point, the acquisition of Technisys back in 2022. They issued almost 82 million shares of stock to make this deal happen. So why would they do that? Because Technisys gives them a state-of-the-art, cloud-based core banking platform. This wasn't just about getting bigger for the sake of getting bigger. This was a calculated move to pour jet fuel on their most stable, highest margin segment for the future.
Okay, we've gone through the business model, we've uncovered that hidden tech engine, we've seen how the growth strategy works, so let's bring it all home and look at the bull case versus the bear case for an investor.
So the bull case for SoFi really boils down to everything we've been talking about. First, you've got that diversified, three-pillar model, so they're not a one-trick pony. Then you have that amazing high-margin tech platform that's less sensitive to interest rates. You have the productivity loop, creating that powerful flywheel for efficient growth. And finally, you have a management team that's clearly thinking long-term, making smart acquisitions to expand their tech advantage.
But you always have to look at the other side. There are definitely risks here, and these are straight from SoFi's own SEC filings. For one, even with the tech platform, their lending business is still very much at the mercy of interest rate changes. The competition is absolutely fierce, from the big, established banks to other hungry fintechs. Banking is also a super regulated industry, which means dealing with scrutiny from agencies like the CFPB. And of course, for any digital finance company, the threat of cybersecurity breaches is always lurking.
Which brings us to the big, final question, the one that really frames the whole investment thesis. How do you actually categorize this company? Is SoFi just a bank that's really good at using technology? Or is it something else entirely? Is it a technology company that just happens to hold a bank charter to power its ecosystem? I'll leave you with that, because how you answer that question really changes everything.